So to kick this off, Hugh, could you talk a little bit about behavioral finance and why this stuff even matters? Why do emotions matter when we talk about money?
Well, thank you, Lauren. Emotions matter a lot because they are what get in the way of investors' success, and that really becomes the area that financial advisors need to help the clients. So the reason that clients often fail with their investments is because of their emotions, and what behavioral finance is about is recognizing that we as human beings are flawed, we're not perfect, we make irrational decisions, and the world of behavioral finance has put some science to that to help us predict what some of those irrational behaviors will be in investors. Yes, yeah.
90% of bad decisions are made because of emotional distress.
Most decisions are from emotional distress. Yeah. People are most rational. There's really two parts to that. When they're feeling confident, but not overconfident. They're just in that happy place where their life is going well, everything's going to plan. That's when people are more likely to make a rational decision. They've got the right people in their life. And I think the other area as well is when they're communicated with on their terms. I think one of the things that can trigger people negatively is when there's bad communication. If they're communicated well by their spouses, their families, their work colleagues and their advisors, then they're more likely to make better decisions and more rationally because they've heard that information the right way. I was going to sort of support what Jesse says in terms of having a goals-based financial plan for the long term helps a lot in terms of putting an anchor down and making good decisions. Also, when people define themselves about how much money they have today, and their whole life is defined by how much money they have, that is also when they're going to make irrational decisions. So that's something that is very difficult for people, to deal with because we are often self-validated about how much money we have at a particular time or how much we're earning. But really, at the end of the day, it's about building a plan for the longer term, and people are then going to do better and not be worried about just what they've got now. I was going to add to that. I think that one interesting point comes out is when people get in touch with what their values are, that becomes a very good framework to make decisions. And so helping people understand what their values are, what their passions are, really to me is very foundational to setting goals. I think the other part that I address with clients is to get them to look at what are the best financial decisions they've made and what are the worst decisions they've made, because there are usually patterns of behavior that are repeating themselves, and if you can get the person to see that, then you're likely to be able to help them and they'll become more aware and start to get on the path of behavioural change. For me, the one that I look at the most is really the Dalbar research that shows the gap between an investor who does it themselves versus an investor who has an advisor and just invests in a market portfolio. And there's, depending on when that Dalbar study's been done, but there's around a 7 or 8% gap almost all the time.
Percentage points annually, correct?
Yeah, annually. So it really does prove that if you get to not do it yourself, not to speculate in the market by just buying the stocks yourself, to buy market-based funds and to have proper advice, there is 7 or 8% on the table. People don't like to sell. A lot of people don't really want the personal conflict of actually taking a loss. Investors dislike losses 2 times more than they prefer to have a gain. And so wrapped up in that research is really why a lot of us don't take those losses. We think the investment's going to come back. We don't want to have to be accountable to somebody else that we lost money. There's personal shame. So there's some of the reasons why people don't, but it can be very punishing to the portfolio because those stocks will just keep on going down. Well, my favourite is Daniel Kahneman, and there's a second one. Mir Statman is a second one. They're both very well known.
Statman's at the University of Chicago, and Kahneman is at Princeton.
Yeah, Kahneman was at Princeton, and then Statman was at University of Santa Clara in San Diego.
That's right.
And the reason that I like Daniel Kahneman is because not only because of his work in prospect theory, which is really around losses, but he also recognises that people have two levels of behaviour. They have a level 1 behaviour, which is natural, instinctive behaviours, and then they have a level 2, which is more of a learned behaviour where the person's learned through awareness to adapt their behaviour. And the key point here is that the level 1 behaviour takes over when the person's under pressure. So a lot of the things we've been talking about this morning in terms of divorces, selling a business, and bad relationships put people under pressure, and they revert to this level 1 behaviour. They can't control it, and that's where these emotional decisions are coming from. So Kahneman's done a lot of work to bring that point out. Yeah, I want to add a little bit of colour to what Manisha has said, in that I agree overall that in the end women are going to be more rational. That would be my conclusion as well. I think women are better managers of risk. They're nurturers, they've got to look after the home. So there are a whole lot of rational reasons why they have to manage their emotions. But as human beings, when you get down to people's natural instinctive behaviours, which drive a lot of us, men and women are pretty much equal in terms of being, at points rational and emotional. But I think at the end of the day, in terms of managing it, which is really a learned behaviour and comes from value sets and also the fact that men and women are biologically different, I'm going to lean towards women being better managers of emotions when it comes to money, because they've got to look after the family. I think so. I think I'm sort of at the place where Jesse is. I think the access to information changes a lot of things.
It changes the playing field.
But also the boomers had to work pretty hard. A lot of them, certainly the ones born in the 60s, have had to work pretty hard to make their way up to the top and have what they've got. Whereas a lot of the millennials, to some degree, have had it handed to them on a plate, and the growing up part wasn't as tough for them. And so at some level, some of them are spenders because they've not been faced with an empty refrigerator, and so that's got to be played in there as well. Yeah, I was going to just to add to this. I think a lot comes down to communication, and I think often we forget about communication. So for me, in our approach to this is, yes, we've got someone behaving irrationally, we've got to lay out the framework, they've got to see the consequences of their decisions, but how they are shown that information and the words that get used is important, because some people are very goal-driven in nature, and understanding what's going to happen to their goals and where they're going to be in the community is important. Others are going to worry about their lifestyle, and those are the sorts of words that need to get used. You can talk to some people about you're spending too much, but actually you need to talk about and start using words like budgets, but actually if you use the term spending plan, that might get them to change. Other people are going to be more worried about their family. If you can demonstrate the impact of this on their family life, they're going to respond to that. And other people, it's just going to be totally tactical about the dollars in the bank, and you can talk in those terms and give them all the research. And so, at the end of the day, we're trying to do the same thing. But it's what words get used in what order is very, very important, and it really gets down to communication and learning style. So I can answer that. Well, and I have to preface this: I used to be an advisor doing what Jesse and Manisha did on a day-to-day basis. So I am a behavioural finance specialist. But what we do when we're working with advisors and with their family clients is that we have them go through a financial personality assessment up front, so that they get awareness of who they are and what these biases are going to be that are going to impact each person differently, and then have the conversation around that, and to start to build the plans based on knowing this information about effectively who you are, to build that level of personal awareness. Yeah, I think in terms of choosing an advisor, a lot of it comes down to clearly technical skills. Having a CFP is important, so having the education and experience is sort of, to me, a given. So the rest of it after that is going to come down to what I call human chemistry. So the advisor, the client and the advisor have shared values. That's very important. If they're not shared values, you're not going to be able to have the hard conversations that you need to have, which is what we've been talking about today. And then I think the other part for me is around behaviour, communication styles, and how you're going to relate to each other. And is the advisor prepared to be open and transparent about themselves with the client? So it becomes a mutual guiding journey, and it's not just a one-way show. I agree with what Manisha has said. I think I take sort of two approaches to this. and I've helped a lot of advisors with it, and when I had an advisory firm, I had to go through this as well. And so I look at it rationally in that, looking at the pool of clients that you have, the rational answer is how much time is it costing you to serve that client for what you're getting paid? So that's a rational answer. Is it a profitable experience, basically? And sometimes what advisors have to face is that their largest clients are not the best clients when you come down to that analysis. And so that can become a very difficult choice. And the other part is, does the client keep you awake at night? Do you wake up in the middle of the night thinking about, gee, this client is going to sue me, I've got these problems with them, because then that has become an energy drain and an emotional drain, and likely for you as the advisor, you may make an irrational decision with them at some point. And then I think the other one is, will the client follow your advice? And if they're going to continuously not follow your advice, then it's very difficult to advise them. Yeah, I think it's, what Jesse's getting at is actually a client service issue or a customer service issue for any business. And I know with our business, we deal with a lot of people, and I look at those clients that we have, or advisory firms and other businesses, that if they treat my staff badly, then that is potentially a signal that has to be addressed in terms of whether that relationship's going to continue. And it might be, all right, we've managed expectations badly and served the client badly, then we have to own that. But there's other times where if the clients are abusive, that's a problem because you're going to not have staff retention. They're not going to be engaged, and that just threatens your whole business. And that's a bigger cost than one client, and you've got to weigh all that up. It's a big issue. I think one of the other ones is if the client or the investor is looking for a particular rate of return, and they are going to hold you to that, and that rate of return is unrealistic, then that's a really bad way to get started.
Yeah.
And as a advisor, I don't want to deal with any client that's going to hold me accountable on those terms.